Well, let's talk about this because one of the things you mentioned this definitely, and you were investing during the dot-com era, and it's so funny how when something becomes sexy or trendy, they everybody and is like someone that's raising capital, they brand themselves according to that trend. So it's easier for them to raise capital. And as an investor, you have to really weed that crap out, that shit out. And so I'm curious, Paul, you mentioned kind of underwriting challenges, if you will, right now, and looking at okay, because it's kind of a weird market. It's like, well, how do we look at this? We have a strong thesis. We know what back end stuff, but also we want to make sure that when we're underwriting this properly, whether it's the fund manager or whether it's just kind of co-investing alongside someone, you want to make sure it's proper and doing that right. What are you noticing in regards to like certain challenges that you're seeing to be able to get the right data, get the right information to ensure that you are making the right decision for your family office?
Yeah, I think it's a balance, right? Because our job is to try to weed out the noise, signal and noise, and you want to listen to everybody, but at the end of the day, you got to make your own decisions, and and you've got to be mindful of the incentives, what the banks, what the big investment banks are telling you, the JPM, Goldman, et cetera, are telling you, versus what the gloom and doom managers that are trying to raise money for gloom and doom scenarios. So I think it's a balance. Bruce Lee learned and taught martial arts under this philosophy of something called Jeet Kune Do, which is really about being prepared for multiple scenarios, and realizing that you know you don't want to be allocating to something to so big of a trade that it blows you up. You want to live to be able to invest another day. And it's the same thing, when you think about the way Bruce Lee taught, martial arts and the philosophy of kind of learning all these different skills and, not boxing a boxer and, figuring out how you combat that. So, yeah, it's the only free lunch, as they say in investing, is diversification. And, when you're in the family office game, it's more about the stay rich game, right? And it's not just stay rich in the short term, but it's stay rich in the long term, because the silent killer is inflation, as we went through this bout of inflation these last couple of years. And I think that inflation is going to be somewhat higher than it's been over the last 20 years. I don't think it's going to be at 5+%, but it's probably, the volatility of inflation is probably going to be higher than we've seen in the past. And you need to hedge against all of those types of risks. So just as I mentioned earlier, just purely putting all your money in 10-year treasuries at 4.5 or 5%, I don't think that gets you all the way there either. You need to still have some type of growth on your balance sheet. And so you've got to explore other things like equity, like, dare I say, commodities. I think commodities are pretty interesting here. But that's also an asset class that's tough to get exposure to. Emerging markets, that's an interesting one. I will tell you, I've been investing for 25 years, and rarely have I seen emerging markets work out over the longer term. I remember traveling to Brazil extensively in the 2000s, before the great financial crisis. And this one manager told me, listen, Brazil is one of these markets that does really well for 3 or 4 years and then crashes by more than 50%. And so you just need to be mindful of that. And I think that's largely emerging markets. We invest in broad-based emerging markets when we want some exposure. As I said, over the longer term, I would be lying to you if I told you that, we hit home runs in emerging markets. I mean, always emerging markets are supposed to be providing, a risk premium over the developed markets. Otherwise, you wouldn't take the risk. Even folks like the legendary investor here in Boston, Jeremy Grantham, that has been bullish on emerging markets for 10 or 15 years and showing people that they're going to outperform. That just hasn't worked out. All of that said, we like Greece here. Somebody once told me you never want to invest in a country where you like to vacation. I admit I like to vacation in Greece, but we think Greece is actually setting up to be a pretty interesting trade, both politically. Finally, the political tide has turned there. There's a lot of really cool stuff going on in Greece, in Athens. In Athens, they took this airport. It's been shut for like the last 20 years. If that was in America, it would have been, developed inside of 2 or 3 years, but it's been shut for 20 years. Finally, the Greeks have gotten their shit together and are developing what they're calling the Greek Riviera, which is this incredible piece of land, right outside, right kind of inside Athens, right on the coast, and is setting up to be, a pretty special place. I mean, you can go get a really nice condo there for $1 million. So I think, and they're saying that Greek Riviera will ultimately add about 1% to their GDP, which is pretty interesting. So, valuations are very compelling, even though Greece has done really well the last year. it's one of these markets that was really kind of overlooked over the last 10, 15 years from low rates. When you look over the last 10 or 15 years and you look at performance of a lot of different asset classes, you really have to ask yourself what was due to the underlying fundamentals of this asset class versus what was as a result of low rates. Real estate would be one of those things that was boom time because of low rates. And there's just a lot of stuff that got built in these secondary and tertiary markets, like the Denvers and the Phoenixes and the Nashvilles and Raleigh Durham and all these markets because money was so cheap. And as a result, it begets, continues to beget kind of the success and the performance. Low rates, refinance, pull your money out, build again. Does that continue in the future? I have no idea. We're betting on it in certain markets. But Greece has been one of these markets that had not been positively impacted by extremely low rates. And, if you remember 10 years ago, coming out of the great financial crisis, there was questions as to whether or not Greece was even going to exist. Was Greece going to be wiped off the map? And was Greece going to be dropped out of the Eurozone? We were betting that it wasn't at the time. And my CIO and partner was very, prolific and very pointed about that. But today, and he's Greek, by the way, and he's actually not liked the Greek trade for the last decade, but he actually really likes it today. So between my partner and my CIO, we've been really looking at this Greek trade, and you can buy it through, there's a couple managers out there that have funds. There's an ETF. I'm not sure ETF gets you all the way there, or you can figure out how you buy a basket of stocks. But Greece looks pretty interesting. It looks like it's setting up for, a multi-year run, in our opinion. So, but it's also a trade you want to be measured, and it's like a 1 or 2%, 100, 200 basis point position.